right, we'll call the meeting to order. Roll call present, myself, Fire Trustee Chair Eugene Dugan.
Leah Hayes, Police Trustee.
Walt Berry, member.
Steve Arbell, trustee.
Gregory Williams, staff.
William Johnston, staff.
All right,
Cole
we have-
Jacobs, WTW.
Thanks, Cole.
All right, we have an agenda before us. We'd like to make some changes. Bob is supposed to be on line with us eventually, but can't make it this month due to an illness. We recommended moving the item vested terminated member benefit eligibility to the next available meeting. And since he's not here, we don't have one scheduled in July. We can discuss later on in the meeting if we want to shoot for July or push it to the August. Is there any other amendments to the agenda? With the amended agenda, is there a motion to accept?
So move.
Second.
Seconded. All in favor, say aye.
Aye.
Any opposed? Motion passes. All right, we were all distributed the minutes from May 25th. Is there any objection to waive the reading of the minutes for approval? Was that an objection?
I said no objection.
No.
Sorry.
All right, seeing none and hearing none, we will consider the minutes from May approved. All right. I don't think Bob's on yet, as far as I can see.
He won't be on this morning.
We won't be on at all.
Yeah.
Oh, I thought he, okay.
Yeah, I'm sorry.
I spoke with him briefly yesterday. I thought he said he wasn't.
He
Tried to try.
wasn't really even feeling up
Yeah,
to being on the Zoom, which is why I was suggesting possibly a July meeting.
Okay. If we're waiting on him though, it'll be around his schedule, I guess.
Yeah,
I'll
yeah,
throw a couple dates out.
yeah.
Okay, perfect. Moving right along. Presentation from Cole, Willis Towers Watson, and Jacob also.
Yep. Thanks, everyone. So pretty standard agenda today. We'll give a quick capital markets update and look at the planned performance as well as we do every meeting. But in addition to that, we're also going to just dive a little bit deeper into a strategy review, kind of background on how we got the portfolio where it is. So spend just a little bit more time on that since we don't have an investment manager calling in today. So with that, I may start on slide 4. Just give a brief capital markets review. We have data here that is through April, but obviously markets have been pretty volatile. So I'll just kind of speak to some updates since then. The top left corner of the screen, you can see the equity market returns year to date are the yellow bars. So through April, S&P 500 is down 13%. It's currently down as of, factoring in the futures this morning, it's currently down about 22% year to date. So we've continued to see more volatility, through April into May and June as well. The same can be said for the rest of the indices listed here. Just kind of further deterioration in valuations. The Federal Reserve last week announced that they were lifting their interest rate 75 basis points. That is the highest amount they have lifted interest rates since 1994. The market initially responded pretty positively to that, given the fact they were trying to, combat inflation. But since then, it's sold off even a little bit more. The Fed will meet again in July, and there's a 90% chance currently that they will raise interest rates by another 75 basis points. So we're seeing kind of a much more kind of tightening of monetary policy, and the Federal Reserve is taking this very seriously now and doing everything in their power to combat inflation. So we'll keep a close eye on the rest of the indices. GDP growth was a little bit negative for the first quarter. That information will come out here in the next few weeks. So we'll see what that looks like for the second quarter of the year. And across the curve on the bottom right, Treasury rates, that pink line, above 3% everywhere from pretty much the 2-year all the way out to the 30-year. So very kind of flat yield curve with rates increasing significantly year to date. Not much really of an update since we spoke last month, capital markets. So just they remain very volatile. So we'll keep a close eye on everything. Happy to answer any questions if there are any. So moving on into plan performance, also looking at the year-to-date column, the total plan has returned 11.2% so far for the first 4 months of the year. That's slightly underneath the policy benchmark of 9.1%. So roughly in line with the benchmark, a little bit underneath due to some of the equity managers, really just the international equity manager. The domestic equity segment returning minus 13.4%, pretty much in line with its benchmark. LSV minus 6.8%, right in line with its benchmark. Vanguard, of course, being an index fund, right on top of its benchmark, and then Sustainable Growth Advisors, down 22% versus 20% for its benchmark. So really kind of all those managers right on top of their benchmarks for the most part. Growth is experiencing much more volatility than the value counterpart. So you can see that Sustainable Growth Advisors is suffering a little bit worse performance year to date, a little bit more impacted by that interest rate rise in that part of the market. Small cap segment, pretty similar story. LSV down 7.4 versus 10 for the benchmark. So actually performing pretty well, all things considered. And disciplined growth investors down about 20% versus about 23 for its benchmark. So also performing pretty well, all things considered. Long-term performance for all these funds, as you can see, remains really, really strong, though. Despite the volatility we've seen so far this year, the last 3 years have had double-digit returns. So certainly, just kind of depending on what time frame you're looking at, performance is still pretty strong across the board. And lastly, Mower, I mentioned, struggling a little bit, kind of dragging down the growth segment somewhat. Year to date, they're down about 18%, and the benchmark's down about 11. They don't have any exposure to some of the energy names that have done really well with the oil price increase. So continuing to keep a close eye on them, but once again, long-term numbers remain really strong. Rounding out performance, looking at the income segment, it's actually positive performance year to date. So certainly adding value to the portfolio when equity markets are being volatile. So that's kind of, and we'll talk about more about this on the later slides, but that's the intention of this piece of the portfolio, is relying more on income of these underlying investments than appreciation. So in periods of volatility, we would expect this to kind of hold up a little bit better, and that's kind of what we're seeing. Alternative credit, slightly negative as a whole. Interest rates are up a lot, as I mentioned, as well as credit spreads have expanded. But despite that, all these funds performing in line with their benchmark. A couple of them in positive territory, like OneSharp and LibreMax. So continuing to kind of perform in line with their expectations and mitigate some of that volatility. And lastly, the real estate segment, really kind of driving the overall positive performance of the overall income segment. Principal and Harrison Street both performing in positive territory thus far year to date. Both are slightly below the NCREIF ODCE index that we show them against here, but both in positive territory and balancing out each other really well. Principal up 8.5 and Harrison Street up about 2.5 so far this year. Any questions on any of the performance of the plan year to date before we kind of jump into the next section?
The Harrison Street performance relative to principal, is that really just coming down to the segments that they're focused on as opposed to principals?
That's exactly right. Yeah. So principal kind of plays in what we call the four main food groups. So industrial, different housing markets, et cetera. Really, industrials kind of is what's driving that more than the other segments. Harrison Street, they're in student housing, senior housing, a little bit more niche sectors. Those two in particular obviously have not done the best during the pandemic, so that's kind of what is driving their performance a little bit weaker than principals. But overall remains like the total portfolio is very diversified. So
I might just kind of reframe that a little bit. So what you saw with principal, given their exposure to those more kind of economically sensitive and cyclical sectors, if you will, so retail, office, they're like, performance was much weaker heading kind of in the initial months of the pandemic than Harrison Street. And so what you've seen over the past kind of year, along with kind of the broader equity market recovery, has been kind of an upswing in the performance of the principal U.S. property fund. But if you had kind of rewound the clock to kind of a year and a half ago, 2 years ago, Harrison Street was outperforming on a relative basis. So what you see with Harrison Street, given their niche focus, as Cole was referring to, is just a much more stable kind of return profile. So what we would expect from both of these managers over a full cycle is similar performance in that 7 to 9% range, which is what you're seeing. But the principal numbers are just going to be much more volatile given their overall exposure to corporate earnings and the economic cycle more generally.
yeah, and you can actually see that in the since inception numbers kind of on the far right. Principal up 7.8, and then Harrison Street up 7.7. So over the long term, just as Zach mentioned, kind of that 7 to 8% on average annual return.
And we've owned that since August 2019. 2019?
Yep, that's right. So
Time
good.
flies. Time flies. Wow.
Time flies. Yeah.
That was a good
We'll have-
move.
You know,
We'll have
and not to confuse the issue, but we have two new real estate managers that will be funding when they call the capital.
That's
And Harrison
maybe-
Street it's another niche product from Harrison Street is one of those.
That's what I mean. Okay, thank you. Yes.
Yep, and the Nuveen Industrial Fund, which I mentioned, that sector has been more robust than others.
Well, it was relatively recent discussion, so thank you.
Yep. So maybe we'll switch gears and go into the next section, which is the strategy review. And so really, we just want to give kind of an overview of the portfolio objectives and positioning, background on how we got here, outlook going forward, and answer any questions that the board has. And so before I turn it over to Zach to walk us through the bulk of the materials, just wanted to give a quick update on slide 9 as to some background as to how we got here. So in 2017, the board decided to move to the delegated model, and we've listed a few of the main reasons for doing so here. In the first section, in looking to achieve the board's objectives, some of the main reasons for making this change were reducing your time and involvement in day-to-day management of the plan, which enables you to focus on bigger decisions. You don't have to spend time working on manager contracting, trades, etc. So kind of the operations piece has been taken on by our team. It also allows you to seek the same high return on assets, but at a lower level of volatility, which we'll speak more about in the following slides. It allows access to our best-in-class managers and real-time portfolio management should you need it. So it enables us to trade quickly if markets move in certain direction, and always bringing you our best ideas. And then at the time of delegation, the fees were significantly reduced. And then as it stands right now, fees are currently break even for a like-to-like portfolio. So you're not paying any more per se on a total level for the same portfolio that you have currently. And then from a plan sponsor perspective, from a city perspective, obviously a large drawdown in assets would inhibit your ability to meet your future return target. So what we looked at there was, any kind of unplanned, unbudgeted contributions would be linked to budgets. So trying to diversify the portfolio as much as possible and mitigate those large swings in returns, and hopefully, reduce unexpected contributions was the main objective from a plan sponsor perspective. So that's a high level review of kind of how we got here, why we made the change. So if there's no questions, Zach will walk us through kind of what the portfolio looks like and some metrics behind it.
Thanks, Cole. Yeah. So on slide 10, we kind of have the high level message here. And so just for background, for the committee's benefit, the portfolio that we've designed here is designed in such a way to meet the long-term expected return on plan assets. So a little bit under 8%. A key component of achieving that objective, that return objective, is a large allocation to equity. So that's why we see 70% on a target basis of the current assets being allocated to equity markets. Now, a few years ago, we introduced target allocations to alternative credit and real assets as a means of continuing to meet that return objective, but to minimize the volatility along the way by introducing asset classes where more of the returns are coming from income as opposed to growth, which is what you see in equity markets. Now, last year, we then took those two buckets, so alternative credit and real assets, and instead of maintaining separate targets to each, we combined them into a single 30% income allocation, really as a means of kind of formalizing the way we were already thinking about it, which is, we're not looking to maintain a set allocation to real estate or alternative credit, but rather we're looking to take a portion of the portfolio, so 30%, and use that portion of the portfolio to meet the portfolio's overall return objectives via income-like return drivers, right? So we didn't want to be forced to own, portions of the alternative credit market that weren't going to support meeting that long-term return objective simply because we had a target to alternative credit. And so if you recall last year, we removed a few funds from the portfolio due to future return expectations in those asset classes. So kind of the two key ones there was global sovereign credit and core securitized, and both of which we hold actually in other portfolios, other client portfolios here at WTW with lower return objectives. And I can say that, from a timing perspective, while we were looking out over the next 5 to 10 years, since we made that move, neither one of those asset classes has kind of performed very well. So it was fortunate from a timing perspective as well. So that's where we sit today. So from a target perspective, 70% allocation to equity, 30% allocation to income, which is currently split roughly 12.5% to alternative credit, and the remainder 17.5% to real assets. We think about looking forward, so how, Cole previewed a little bit how we're thinking about markets. But I think the high level summary right now is just there's a lot of uncertainty out there. So as the Fed continues to hike rates to head off inflation and kind of works harder and harder to achieve this, somewhat elusive soft landing, we are looking for assets that are kind of well positioned to the degree that you can be for that type of environment. So an environment with potentially high inflation, an environment where we could possibly see a small recession, right? And so the types of assets that tend to perform well in that type of environment are assets with much more stable cash flow profile, so income-oriented assets and primarily income-oriented assets that have a direct or indirect tie to inflation, which we'll get into in a little bit. So all that being said, I mean, based on how given the portfolio's current return objectives and the asset classes available to invest in here, we think the portfolio remains appropriately positioned. So we're not recommending any changes at this time, but we've just prepared these materials to refresh for the committee our beliefs in terms of portfolio strategy and outlook. So that's what we're going to go through today, just kind of high-level overview of future return expectations and a little bit more detail on how we think about investing in alternative credit in real assets, but not recommending any changes at this time. So on this next slide here, I think this is a very good slide in terms of kind of illustrating the trade-offs of various allocations. And so what we have here modeled is our current target allocation. So that's 70% to growth-oriented assets, so equity, and the 30% to income. And we've compared that to an all-equity portfolio, because a common question we get, not just from the committee here, but from other clients with large return objectives, is, well, equities have performed quite well historically. They tend to be one of the higher expected returning asset classes. So why not just put all of our money in equity? Now, of course, the market environment year to date is a good example of kind of real life, the risks involved in that, right? As we've seen kind of equity markets sell off over 20%, and that income sleeve that we're currently investing in kind of hold pretty steady. But this is based on forward expectations. And so what you can see here is really two things. One, from a return perspective, that 10-year return number at the bottom there, 7.9%. Whether we're in this allocation, the 70-30, or the 100% equity allocation, based on our capital market assumptions, the long-term returns are effectively the same. So both are expected to meet objectives, right? So clear that hurdle of 7.75% at the median. And they're both expected to return about 7.9%. So regardless of which kind of allocation we went with, we'd be looking at a similar return, both of which are kind of consistent with objectives. The difference really comes down to, between the two allocations, comes down to what I was mentioning earlier, and that's the kind of stability factor, right? And so what you see with the current allocation versus the all equity allocation is, again, the same return profile, but with just much less volatility around it, right? So you can think about, by moving to that income sleeve, you're just taking the potential return distribution and limiting it more to the median, right? So you're kind of cutting off the tails, both positive and negative, such that your return expectation on average is the same, but there's just much less upside, which we don't really need, right? And there's much less downside, which we do need. And so that's what you're seeing kind of graphically here, and that's what you're seeing in the numbers in terms of the annualized volatility and the 5% value at risk. That 5% value at risk, you can think of that as kind of in a worst case type scenario within a given year, what you would expect from the two allocations. So any questions on what's being shown here on the page before we kind of move on?
Is our current policy 70-30 or was it 75-25?
Currently, from a target perspective, it's 70-30.
With these new purchases we're planning on doing, we're going to get more in line. We're a little off right now.
Exactly. Yep.
If we had to buy those today, where would we get the money?
Where would we source the money?
Yeah.
So
we've been looking at who's a little better.
Yeah, so we would look to the degree it made sense to rebalance within the equity allocation, but the kind of the natural source of funds and would be probably the Vanguard passive vehicle, unless you saw one of those active managers way kind of above target.
What we'll typically do is look and see if managers are over their targets,
Right.
trim them back.
I was just curious right now because everyone's down a little, right? But some of them aren't down as much.
Right.
Alternate credit. It's in that 30%, and the real estate's carrying.
Right.
So why?
Then it wouldn't.
Look at the number for that. Even
Then it wouldn't shift into
5
our
years.
policy targets though, right? We took it from.
Yeah, so if we were taking April market values as kind of a given, what we would see is the current small cap equity segment is a bit above target. LSV small cap equity, given their value bias, is above, the 7.5% target allocation. So that would be a potential source of funds. But the way these real asset mandates are typically funded is not all of the commitment is called at once. So we would expect kind of bits and pieces to come in. So the source of funds, will change, but to William's point, it's going to be based on, who's above target and things like that. So the next slide, slide 12, shows, another way of kind of looking at this. So, what is allowing for that return distribution to kind of live more at the median as opposed to the tails, and it's simply based on kind of broadening the underlying return drivers, right? So this kind of breaks out nicely some of the different inputs into portfolio returns and the way we think about it. And so you have equity, of course, you have skill, which you can think of kind of a manager outperforming their benchmark. But then you have these other ones right here in the middle that if you're running an all equity portfolio, you're not really accessing. So things like credit risk, things like term risk, things like real assets, illiquidity, right? And so within the income sleeve, those are some of the buckets: credit, real assets, illiquidity, that we're looking to kind of increase exposure to, which allows, again, for a similar return expectation, but with much less risk, given you're broadening kind of the underlying drivers that you're relying upon. So the next slide speaks a little bit then to how we think about building the income segment more generally. And again, so, it's the same themes that we keep kind of hitting on. So diversification, right? So looking to gain access to return drivers that are different from equities, like we just showed on the previous page. And return drivers, importantly, that are less exposed to the broader economic cycle, such that if we were to enter a recessionary environment, there'd be some amount of resilience within the portfolio. The other key thing, in addition to some of the, the other ones on here, like fees, of course, and specialists, is the cash flow generation piece, right? So looking to access strategies where the primary return component is going to be income as opposed to growth. And the nice thing about income is that tends to be steady year over year, whereas growth can fluctuate quite significantly. So those are kind of the two key things when we're thinking about, what makes sense for an addition to the income segment. It's going to be, one, does it meet the portfolio's return objectives? And two, is it meeting those return objectives by relying on return drivers that are different from equities and a kind of source of returns that are primarily income related? So there's two kind of components of this income segment currently. If we go to the next slide, the first is the credit or the alternative credit component. So the managers within that currently would be the Ares High Yield Fund, the BNY Mellon Fallen Angels Fund, the Libra Max Value Fund, and the One Sharp Fund as well. So those four funds are what sit within the alternative credit bucket. And the way we think about, building an alternative credit bucket is laid out here nicely on the page in terms of diversification, not just by manager, right, but by underlying kind of exposure. So whether that's geographic, type of borrower, so corporate or consumer. There's not much government exposure. Actually, there's not really any government exposure at all in the portfolio now. That was in the portfolio with the global sovereign credit mandate, but we took that out based on kind of future return expectations. So right now we're kind of focusing on two types of borrowers, so corporates and consumers. consumers, of course, offer an element of diversification from kind of the broader corporate earnings cycle. And so that consumer exposure we see primarily in LibreMax and One Sharp. You kind of place in the capital structure, right? So you can, within kind of alternative credit, you can be more senior or more subordinated. So we have various types within our mandates. And then kind of importantly, the type of collateral backing the assets. So whether that is kind of balance sheet capital or things like residential property, which we see with the One Sharp mandate. So, within alternative credit, looking again to broaden exposure beyond just kind of corporate earning cycles, but to different types of borrowers and types of collateral. Now, as I mentioned at the outset, if we flip to the next slide, a kind of key component in this current environment, right, is the degree to which these assets are linked to inflation. So here on this page, we have different types of income investments, their yield, their liquidity, and whether or not they're in the Gainesville income segment. I would say, as you're looking at this page and you're kind of noticing, okay, well, certain things seem like they have a very strong link to inflation, but they're not in our portfolio. Things like, senior secured infrastructure debt. The reason those tend to be not in the portfolio is one of two reasons. Either the yield is low, so it's not going to meet our return needs, as stated at the beginning, or they're quite illiquid, meaning not kind of able to move to cash within a kind of time frame that we view as kind of appropriate for this type of portfolio. So if you think about something like a senior secured infrastructure debt portfolio, that would typically be a closed-end fund structure where your capital is locked up for anywhere between 5 and 10 years, right? So not only do you have a low yield there, but quite illiquid. So where we are playing is in the kind of more liquid to semi-liquid space where the yields are much higher. So great example on the page that we've discussed quite a bit and has performed quite well would be that bridge short-term lending, right? So kind of short duration loans, less than 1 year, that allow any type of increase in inflation costs to be kind of reflected in the underlying rates that are being charged to borrowers. And so that would be the One Sharp mandate, and that is something that is included within the portfolio. LibreMax would be another good example. So that would fall under kind of two categories, both the CLO one there at the bottom, but also the floating rate high yield asset-backed securities. So again, very high carry per unit of duration. So kind of a very high yield that provides a buffer, if you will, in any type of rising rate environment. But also the instruments there are floating rate, meaning that as interest rates creep up, they reset, and the interest rates being charged there, the income being generated kind of scales up alongside rising cash rates or rising inflation. So the next slide then speaks to the kind of the other component of the income sleeve, and that is the real assets piece. Because the way we think about, again, real assets is not too dissimilar really from the way we think about alternative credit, in that we're looking to access kind of the broadest base of underlying sectors that we can, and fundamentally looking to diversify exposure again from broader corporate earnings. And so we have exposure to the traditional areas of the traditional sectors, as Cole noted, via principal. So things like office, apartments, retail, industrial. Those are the core sectors that make up the Odyssey Index. They also tend to be the most economically sensitive sectors, right? So when looking to add to the real assets portfolio, we're looking to access sectors that are less sensitive, but also able to generate returns commensurate with our objectives. So things like storage, things like healthcare, things like data, things like energy and water resources, social infrastructure, things like that. So again, looking to broaden exposure beyond just those kind of traditional areas that tend to be the most economically sensitive. The next slide provides kind of a good proof point in terms of, long-term return expectations of kind of a real assets portfolio versus equity, right? And kind of to my point at the beginning, what you're seeing here. So this is starting at the beginning of 2008. So it includes the financial crisis. And what you're seeing really is what we were kind of modeling at the beginning, which is ultimately very similar return profile or long-term return expectation, not return profile, but long-term return expectation with a much smoother return profile. So the purple line is equities, the green line is real assets or real estate. And what you're seeing, right, is just a much smoother line on that real assets front than you do see with the purple line, but you end up at a roughly, similar spot. And the key driver behind that, of course, is the income component, right, which is allowing for that stable return profile, whereas the purple line is being driven much more by growth.
Are these particular indexes you're showing here on this graph?
Yep. So the indexes are kind of noted at the bottom. For the equity index, that's ACWI, so global equities. If we were to use just the S&P 500, it'd be a little bit higher, but similar kind of story. And on the real assets, it's a 50-50 of a private global infrastructure and global real estate index. Again, these are index returns, but kind of the point of the chart here is.
But we wouldn't be we're not invested in global infrastructure.
No, we do not hold global infrastructure currently.
So you're using indexes that don't really apply to us.
Well, it's more of it. It's not what I'm showing here is not necessarily to say this is what Gainesville's portfolio will do. It's more to show that if you're comparing global equity and global real assets, historically, right, returns have been quite similar. The differences have been primarily on the kind of volatility front, which is something that if we were to show.
These are kind of cherry picked indexes, I have to say.
It's not relevant.
But I mean, I understand what your point is, but you're cherry picking indexes to make your point.
Well, yes and no. I mean, so what we're showing here is a global equity index, and we're comparing that against a global real assets portfolio. But yes, I mean, to the degree that Gainesville holds a portfolio that's primarily domestic equity and domestic real assets with much more of a focus on real estate as opposed to infrastructure. Yeah, of course. I would say also too, I mean, the infrastructure assets are not really it's the real estate component here that's been the higher returning piece versus infrastructure. But yeah, I take it's a fair point, William. Point here is more to just show historically in a global context, two types of asset classes and kind of similar return expectations, but the difference being primarily driven by volatility.
Fair enough.
And I'm just kind of flipping back just to look. I mean, so we could do, and happy to follow up too, but we could generate a similar chart. I think that would, with our longest held, I think Principal, right, has been the longest held real asset strategy going back to, February of 2005. And we don't have any, let's see, do we have a 10-year number here? Yeah, so Principal over the last 10 years has done 11.1%, right? And if we look at Vanguard, do we have Vanguard? We don't have Vanguard for 10 years, but we have our large cap equity segment for the past 10 years, and it's been 12%, right?
Well, yeah, but 10 years doesn't capture what happened with real estate in 2007 through 2009. So if you include that time period, those returns are going to look different. And also, we've been locked up a number of times with Principal. I mean, I like Principal. They're a good real estate manager, but one of the issues we have with that type of investment is when the markets get volatile, they lock us up and they become illiquid.
Absolutely. Yeah,
So, I mean, you know,
Absolutely.
there are
Yeah.
multiple factors that we look at.
absolutely. Yeah. And
ETFs.
that's a good point, William, and a reason why we don't, why that income segment is limited to the 30% that it is, right? And why we're not holding, a 50-50 type of portfolio or a much larger allocation, because those points around liquidity do matter. So absolutely.
I don't mean to jump ahead, but can I ask you a question about one of your graphs, the bell curve graph that showed expected returns based
Yeah,
on
of course.
the different models? And, I don't want to steer the discussion away from somewhere that board members want to go, but when I look at that graph and I compare it to your capital market assumptions, which you have listed on page 22. And again, I don't want to get too far ahead, but I have some issues with your capital market assumptions. But on page 22, you're showing equity, US and global equity passive. Your 10-year median capital return assumptions at 7% and 6.7%. And then the asset classes that I look through here and see that are part of our income segment, whether it be the alt credit or the real estate.
Yep.
And I look at those 10-year median returns, they seem to be substantially lower. And so I guess I'm wondering how the allocations to that 30% income segment with those lower expected returns, how you're getting a similar expected return profile for the entire portfolio if it were all equity versus 30% in the income segment.
Yeah, absolutely.
I mean, I don't have the numbers in front of me, but just eyeballing these, it doesn't seem like that's possible.
Sure. So the kind of key difference there, and what is not reflected in those kind of generic capital market assumptions, are two things. But one is the kind of alpha expectations, right, of the individual managers. So all those capital market assumptions assume kind of general passive exposure to the degree that you can do it. And then there's the specialist component as well. So a lot of those real asset managers are accessing not just kind of your core direct property markets, but specialist type sectors with higher yields, higher expected returns as a result. So you'll see, right? I mean, the all equity portfolio of 7.9% is also above what's shown in the capital market assumptions for equity, right? And that's a function of underlying alpha assumptions as well.
So without, doing actual calculations, it sounds like you're applying a much higher alpha to the income segment managers than you are to the equity managers. Would that be fair to say?
I would say fair, although it's an alpha. So alpha in the equity segment tends to be completely driven by manager skill, right? Meaning this manager is going to outperform the index based on their stock picks by, X%. Alpha within the income segment tends to be both manager skill versus benchmark, but also kind of opportunity set, right? So it's a little bit different in that within the income segment, they're able to access areas that there just aren't kind of passive benchmark exposures to. So that alpha component being reflected is skill, both in terms of kind of outperforming some type of benchmark, but also skill in terms of accessing an opportunity set.
Okay, that makes sense. Thanks. Didn't mean to interrupt your presentation.
No, I mean, that's what we're here for. So happy to answer any questions on any of this. But I mean, all I really had left, William, was the I think slide. Let's see, is it 18 really, which is the same idea as what we showed for alternative credit, but just components of the real asset space where you have a more direct tie to inflation and those where you don't, and where we're playing, right? So, things like renewable energy and kind of development type strategies. Currently not in the portfolio, either due to low yield or general illiquidity, or a mix of both. And things like longer duration real estate, triple net leases, shorter duration real estate, where the liquidity, where the yields are higher, or the liquidity is higher, are within the portfolio. So kind of high level messaging here being that elements within both the income, within the alternative credit and the real asset segment are well positioned for an environment of inflation, and they're also well positioned relative to equities for a potential kind of economic downturn, given they're just general less sensitive to corporate earning cycles and that kind of income component of the returns. So the next two slides, 19 and 20, just provide for the committee's benefit a reminder of what sits within each segment, current targets, our return objectives, and the fees that are being charged.
And I mean, I will admit, there's no doubt that the income segment has benefited this portfolio, certainly for this calendar year. And this plan's performance is better than the general employees pension plan performance, because they have basically a 90% allocation to equities. But when the market recovers, that performance, that relative performance is going to reverse. Just keep that in mind.
So, and I have a question now, without asking you to be a prognosticator, are you suggesting that our position that we're in today regarding the income segment versus the total equity is where we ought to be, and that in fact that will continue to accrue benefit to the plan? I guess that's whoever wants to answer. And nobody appears to want to be a prognosticator.
Sorry, was that a question to us or to William?
Yeah, it was really to the netherworld, but probably to you, because I don't know that you have an answer to that. Except the portfolio is based, it appears to me, based on what we have now, your portfolio seems to indicate that, I won't say more is better, but our existing mix is better than if we were to move more closely into closer to the 80 or 85% equity position.
Yeah, I think I would say if we could predict. So I think what's tricky is the last couple of downturns from so since the crisis, you had a kind of a small downturn in 2011, you had a sell-off in 2018 towards the end, and then you had the COVID one. In each of those examples, the drawdown and subsequent recovery was quite quick. And the common theme throughout all of those was that you were in the midst of a kind of Fed easing environment, right? So accommodative monetary policy throughout, right? Right now, and again, we don't have visibility beyond the next couple of months in terms of what the Fed's going to do. But right now, given the inflation pressures, the impetus from the Fed standpoint seems to be the opposite, right? So tightening financial conditions, and the degree to which that drives this country into a recession and an extended deleveraging cycle, remains to be seen. But point being, we would expect higher volatility over the next couple of years, and potentially a much slower eventual recovery than we've seen in previous markets, just given that difference in Fed posture. Now, of course, anything could happen. And if you told me, markets were going to recover to where they were at the beginning of the year in the next 12 months, would an all equity portfolio be more favorable? Yes, but we never know that in hindsight. And so I think, given the particularly high levels of uncertainty now, this type of structure where you have a much stronger kind of visibility in terms of future returns within that income segment versus that growth segment. This type of structure is kind of the one we would want to be in for this environment. But again, we've put these return objectives here on the page because we hold these managers to these numbers and we expect to be held to them too. So when we're looking back in a few years, these are the types of returns that we would expect. And if strategies like LibraMax or One Sharp are failing to meet those over time, that's I think a time to revisit the strategy and in particular the managers. So this is not a kind of set it and forget it type of exercise.
Any other questions from anyone? I know we covered a lot of material here.
Yeah, maybe I'm looking at this way oversimplified, which wouldn't be the first time or the last time in my life I do that. But back on 10, when you in your outlook, in where specifically underlying government slows their pace of spending, you are referring to the government's ability to appropriate new funds. Because a few meetings ago, there was a great slide. It's one of the clearest pictures of why didn't we see this coming, was the growth in the M1 money supply that happened over about a 24-month period. Most of those funds still haven't been deployed. They're still filtering. The direct-to-consumer stimulus, those folks did exactly what the government wanted to do. They spent it. But when you give money to state and local governments, my experience has been we are not as quick to allocate and deploy those funds. So this idea that we reach a 2.5% inflation rate, that's going to require some type of a fix in the supply chain, because you still have a lot of money that's going to be chasing fewer goods. It'll just be the government that'll be driving up the inflation rate at that point. Am I oversimplifying that? Or
No, it's a good way of looking at it, and I think we would largely kind of agree with your assessment. I think a key difference, right, is in terms of the components of CPI, right? It's consumer spending that is going to be driving a lot of those in terms of you strip out energy and food and just kind of focus on core, right? You're looking at the largest component there, right, is rent, right? And so year-over-year changes in rental prices, and that's driven by consumers, not necessarily government spending. So what we've seen since, to your point, what we've seen since 2020 is that those elevated saving rates that we've seen with consumers have now come all the way back down and then some, such that savings rates are now lower than they were pre-COVID for the consumer. So you have that combined with no more further stimulus payments, as well as kind of a rising rate environment, which is increasing kind of costs for consumers in a variety of ways, in addition to just a generally high food and energy prices, all of which we think is going to support kind of an eventual decline in consumer spending. That feeds through into a decline in corporate earnings growth. That's how you eventually start moving towards a potential recession. But I would say that 2.5%, you're right. In order to reach that near term, you're going to need some kind of unclogging of the supply chain. And it seems like any time that's about to get going, something new creeps in, whether it's China going back down into a kind of full-on lockdown mode, whether it's Russia invading some countries like Ukraine. But the current market pricing in terms of kind of inflation expectations and the way we kind of look at that would be 5-year break evens, is right around that point. So right around kind of 2.5, 2.85. And what's been kind of interesting over the last couple of months is inflation expectations from the market perspective actually peaked back in March. And they've now, over the last couple of months, been trending down. So you've been seeing a lot more kind of press about inflation. But within markets, that story seems to have passed, and inflation expectations are actually coming down because people are kind of looking forward now and expecting this Fed rate hike cycle to weigh on consumer spending. And actually what you're now seeing is the story switch from an inflation one to one more of a kind of recessionary type of story. And the way that's kind of reflected in market pricing is you're starting to see the price of risk assets kind of blow out. So spreads within corporate credit markets, so the excess yield you're expected to be paid on versus a government bond, that's increased quite a bit over the past couple months. You've seen the decline in equity markets as well over the last couple months, which is another good proxy. All of which speaks less to inflation concerns and much more to kind of corporate earnings concerns and potential recessionary scenarios. So I'm not sure if that answers your question. I would say you're thinking about it the right way. Government spending, can support an extended kind of period of inflation, but I would say that kind of the key components of CPI tend to be much more consumer oriented than government. And what we kind of mean here in terms of government spending coming back, it's more in terms of the support programs that were extended to consumers during the pandemic have now been kind of removed.
Yeah, but there is a subset of goods and services that both the government and consumers intersect in that Venn diagram. And a lot of that government spending is governmental trickle-down economics is going to end up in the pockets of consumers because somebody's going to build those roads. All I know is that, how long ago did we receive our ARPA funds, William? Do you remember?
We got some just a week or so ago, 16 million.
The first 16 has already arrived, right?
Yeah.
Or is that the second tranche?
I think
Sorry.
Is that the second tranche of the 16?
Yes.
Okay.
this came last week.
So, and I suspect the actual deployment of those funds, probably less than $500,000 at this point. So, and I don't know that we are that much different than other local governments that have received. Some have been more efficient than we are, some have been less. But, I mean, those funds are going to be used in the same pond as for goods as consumers use. So I would love to be, and you all know me as the eternal optimist. So I think 2.5 by second half of 2023 is
To
just,
reintroduce myself.
it's just, it is hopes and prayers,
That's an interesting observation. Particularly, well, not necessarily about what we're talking about here, but domestically, locally. I've been hearing those numbers. And I know that's the case.
So you don't think a recession will drive down the inflation because of the supply of goods shortage and everything? Like it did in 08, 09?
I think the key is unclogging the supply chain at this point.
I'll tell you, they were all on I-95 yesterday, unclogging it, so.
People are like, the highest fuel prices are, people are still trapping.
Yeah.
Right?
I know, it's traffic was really bad in 75 and 10 on my way to and from Pensacola last week. I'm thinking, where are these people getting the money to drive?
Or you want to see I-85?
No.
So I don't know,
No, that's, but
I don't know what to do about it. I'm just saying that, boy, I'd love to see it, like that optimism.
the people who make, I'm afraid, decisions about our ARPA money, for example, and I'm talking not present company, obviously, but other people who are making those decisions aren't usually in the habit of being able to allocate that amount of money that quickly and be considered that generously, that generous of a benefactor. So I think they're keeping them very close to the vest and kind of waiting to see what happens and who really needs it and who wants the portion of the pie that hasn't been allocated. Who knows?
Locally speaking, I think they've already determined how they want to spend it.
Yeah, I'm not, yeah, exactly. Locally, I think we've actually got a handle, but I think there's a lot of places that I've been
I think they
hearing about, listening.
got some specific projects.
Yeah.
Disagree with you there, but they also, a lot of them are conceptual buckets, right?
Well,
Affordable housing, $9 million. Well, what does that mean?
oh, with grocery.
Then you go through,
We want to fund a grocery.
let's earn
store.
some money on that one. Those, you know, you guys have that.
You get a plan and well, maybe not that grocery.
I'm kidding.
Cole and Zach, did you guys have any other information you wanted to talk about?
No, this is good insight though, in terms of some of the local inflation dynamics. So
You see how the hoi polloi responds.
We're acting as though we can solve global issues on a local level. I think that is consistent with the manner in which our local officials.
Think globally and act locally.
Yeah.
Anyway, thanks, Stephen, for your
I've never
thoughts.
seen- I feel like you described that.
All right.
Well, thanks, guys.
Thank you.
I don't think the board has any other questions, and we'll follow up if they do.
Okay, sounds great. Well, we appreciate the time and the dialogue.
thanks, guys.
Thank you.
Take care, everyone.
Good day.
All right, we'll move the next agenda item to July or August.
Can I make a couple of comments about the presentation real quickly? I don't want to
Sure.
spend too much time on this. And, you know, they make fair points. It's just that personally, it seems to me that they construct this presentation to support their delegated investment program that we're part of in the income segment. And, you know, I'm not arguing that in the current volatile markets that this portfolio is probably going to look better than a 90% equity portfolio.
Right.
I completely disagree. Well, when I say completely, within a range of 100 to 200 basis points, I disagree with many of their capital market assumptions. And I believe that they use these assumptions to support the income segment recommendations. And I don't agree with them. It appears that they're applying a lot of alpha to the income segment managers. They're not applying to the equity managers. That may be valid, but I would like to actually see the numbers they're using to build these models that they say that will achieve the same returns with a 30% income segment as we would with a 90 or 95% equity. I don't believe that. Secondly, on page 23, they keep making the point that we got a fee reduction by going into the delegated investment.
We didn't
platform.
talk
And
about that at all.
That's
did we?
completely not true. That $635,000 that they're showing, that's based on what they were going to propose our portfolio look like. And that was going to include hedge funds and or private equity, which we were never going to do. So it was built on a false structure of a portfolio that did not exist and would not exist. So we didn't save anything, and we haven't really saved anything. Now, it hasn't cost us anything, but I have a hard time with a consultant that we're paying money to putting the idea out there that they're saving us money when they're not.
I think what
To me, that's borderline fraudulent. And, you know, I don't agree with it. And I think it's a huge misrepresentation. Now, my concern would be if the program were costing us money, and it's not. You know, 20,000 give or take, you know, either way doesn't make much difference in this portfolio based on our investment manager fees. But, you know, I just want to, you know, point out that I don't
are
agree.
taking some of the work.
Hmm?
I mean, they are handling some of the
Well, sure.
workload, right?
Well,
Problems we've had in finance, I can't imagine. I mean, would you all have the support to schedule all the money managers and?
the money managers take 5 minutes to schedule. There's no.
Or strategize, I guess.
Well, I have a comment. To go back to what William said, how they sugarcoat some of the things. Are they a monitor or are they a manager? Did we get the manager's report this time and it didn't look good? I just don't understand the two roles.
I have a feeling what we saw today or heard today, or talked about today, is a similar slide, maybe the same slide, that, I don't know, 11 other of their clients are going to receive. And they probably will all have the same questions you have, William, about can't it better reflect our specific portfolio? And I don't know. whether
Yeah,
they're-
I
whether-
just don't agree with the assumptions they're making about the returns.
Well, that's
first of all.
Well, that's just,
Let me ask, because a lot of you gentlemen have way more extensive investment knowledge than myself. The projection there was what, about 10-year, the two models?
Right.
Yeah.
Okay, is it unreasonable to say that they would fare about the same in a given decade? When, if you do have a low, obviously in that decade, the equity and the large growth and everything's gonna plummet while your fixed income doesn't as much. And then there's probably some benefits to selling from your fixed income during those times and not realizing your losses, maybe.
Well,
And then
it
in the
depends on-
turnaround market, you would gain that money back from the, I know Dr. Denslow used to always say, if we just stay in the S&P 500, we'd be fine. But I don't,
Yeah.
you know,
And
Maybe 5 or
how does that work
10%.
when you gotta sell 50,000 or whatever this year, or 20 million to pay for stuff?
Well,
And
when you
stuff's down
think about
40%.
20 million, that's about a couple percent of the 2 or 3% of the portfolio, or 3 or 4 or 5%.
Mhm.
And we may move to doing that quarterly rather than at the fiscal year end, because that's been recommended by an auditing consultant. But I'm not concerned about having to take cash out. It's such a small percentage that even if you take it out at the bottom of the market, it's not going to impact the annual return of the total portfolio.
Right
that
now,
much.
our annual input there, because let's just put it in annual.
Right.
Pay the bill. But okay, go ahead, Steve.
So I think Dr. Denslow was focused, and because I remember, it
Right.
was about
I was thinking about it when I heard.
the fees associated with passive versus active.
Right,
We getting the alpha. I don't think he ever put the whole, he was
No,
advocating for
I
putting the whole
understand.
thing into the S&P.
I know you didn't
500.
mean that, but I know just the idea there is, like you said, working the indexes versus paying all the managers.
So, and we do have at least a snapshot and a view of passive versus active managers, because we do an Vanguard is essentially an index fund.
Mhm.
That's more passively managed. I don't know that the 10-year investment horizon is as relevant to me as I sit here, because this is a perpetual investor, the plan. For example, Eugene, we get to amortize the liability associated with your retirement over your career, 25 years.
What would the
so I
impacts
think-
be on the city, though, if we have 2 bad years in a row and the valves come out and they say we need,
The city would have to put in a higher contribution rate
They won't.
until the market's recovered, more or less.
I'm concerned for the sponsor.
Over any 25-year period, you'll find slices where those
Mhm.
contribution rates started to spike because of .com bust in the early aughts, a housing bust, and there's different strategies that were employed to take out that liability, as opposed to just.
There's always a new liability, though, right?
Yeah, that's kind of the, okay, so you're showing on, I'm not, from my perspective,
I agree.
as a taxpayer more than as a trustee, I think funding status is a terrible measure of, in and of itself as a line. To me, it's the cost of the sponsor to provide the benefit. Is it reasonable? And that's the contribution rate. So, and I mean real contribution rates. If you took out a POB to extinguish some of that liability, those debt service are not part of the contribution, but they are part of resources that could have been used for other services. Or, God forbid, huh?
It's $100.
Yeah, so,
$100.
So since I've only been here since January, this delegated plan is the only thing that I have experience with. How did it work prior to? Was Williams Towers Watson even involved at all?
Yeah, so Willis Towers Watson has, in one form or another, been the plan consultant since around 2000 or a little before 2000. They merged with other companies twice, I think, over this 20-something year period. So they started out as Watson Wyatt, then Towers Watson, and then Willis Towers Watson. And it was a more traditional type of consulting arrangement at that, for up until probably the last 3 or 4 years or 5 years. And so that arrangement, that we had, it didn't really affect what they recommended. They would still be recommending like a 30% type of income segment probably, because that's
their
their
structure.
corporate
Right.
nature. That's what they do. We're probably their only public pension plan
Oh, is that a
client.
fact?
And the return assumptions for corporate plans are structured much differently. They have to use a risk-free rate of return. So in my opinion, Willis Towers Watson is much more concerned with market volatility because of their corporate clients. Because those clients, they have to fund their pension plans using a risk-free rate of return. And so they're using, a 3 to 5% rate of return assumption. And they're forced to fund it at that rate. They wouldn't have changed their recommendations. And in fact, for most of that time, we had somewhere between a 20 and 30% allocation to fixed income and real estate. What the delegated investment platform does is it reduces some fees on a couple of our managers a little bit, not by much.
The international and the real estate.
Right.
Get a little bit of grip. So we're essentially paying Willis Towers instead of those managers.
And, as they mentioned before, they claim it makes staff's job easier because they take some of our workload. Well, we never bargained the agreements, the contracts with the managers. We use Bob Clauser to do that, and we still use Bob to do that. So that hasn't gone away. The one thing they do, and I'll give them credit for this, is when we hire new managers or we bring them on, they work with State Street, the custodian bank, to set up those accounts. Whereas in the past, we would have had to do that. But how much of
And
a
vetting
workload?
And vetting some of the managers.
Well, they would always vet. They would never bring us managers that weren't vetted.
True, that's right.
In the
There are-
past, rather than recommending 1 or 2 managers, which they bring to the board and expect the board to accept, they would bring a short list of 5 or 6 and all the historical data related to those managers. The board would look at them and decide to bring in 2 or 3 for presentations and then select the manager that they thought was a best fit for the program. That's what the delegated investment platform does. It's really set up to be a situation where the board doesn't even have to approve the managers, but we didn't allow that aspect of it to be put into place. The board still has to approve the managers.
So, which actually gets to me the very simple question. Has it provided us efficiency and nimbleness in that process? Yes or no? Because that really was, to me, the salient point to why you might want to consider this. It wasn't, the fees were nice, but I never believed that in the end, the cost is the cost, right? Because there were manager selection processes that took 6 to 9 months to complete.
By the board.
Yes.
Yeah.
And to the board's credit, because give us the list, we'll do the short list, and then we will see each one of them. And if that took 3 board meetings to get them all in, we want to give it time and consideration.
Right.
So there was value in that level but I don't. So my question is that how much time have we saved, and has that resulted in better plan returns? If the answer to that is yes, and I don't even know how you would do the research on that, then it makes sense.
It still takes Bob 6 to 12 months to negotiate an agreement.
Yes, from legal advice.
So, I mean, but we might have
But we
saved.
still might
them-
be 3 months ahead,
Yeah.
right?
How long have we been on the delegated?
I'm not-
We're about 3 or 4
Quarter ahead.
years.
Is that even a long enough period of time to compare? I mean, have we even been part of this for long enough to have like
Since
a legitimate
Before I got.
comparison between the 2 different ways of doing things?
There are benefits to not having to go through a short list, but what you're doing by not evaluating 5 or 6 managers is you're giving control of the portfolio to Willis Towers Watson.
And that's,
And if you're comfortable doing that, that's fine. I'm not sure I agree with their investment philosophy. The very core of their investment philosophy, I disagree with. So for me, it's an issue. But for the board, it may not
Do you think
be.
the managers that bring forward are?
The managers are fine if that's the type of manager you want. I don't agree with the income segment part of the portfolio, and that's where all of the manager, selection has been over the past 3 or 4 years. So
But that's a separate issue, right? I mean, like, we could change our allocation
true.
without abandoning this delegated.
So, correct me if I'm wrong, like prior to 2010, weren't most public pension funds 40% bonds and fixed income?
60-40 was more or less
60-40,
traditional
40 was
fixed.
the fixed.
Progressives are second, third.
And right now, we're already one of the higher equity.
Well, 70-30 is pretty standard now, I believe.
Oh, I thought that's one of the reasons the state's always up on our.
I don't know anything about standard. All I know is I've been in this business for 40, 45 years. That's when I was working at least. And the zero risk approach has always been a bedrock of public pension funds.
Right.
Much more so. I'm not aware of the private sector, so I don't know. I can't speak to that. And I'm also surprised to learn that we're their only public pension plan. But I mean, the lack of the risk aversion for public pension plans has always been, if it had been in the Bible, it would have been a book. And just simply because you've got people who depend upon what we say we're going to give them, that being us, when time comes due. And so I don't have the aversion to a higher than
And,
10%.
to be fair, their income segment, those managers are going to give the portfolio lower volatility. But what I would point out, and this isn't an exact indicator, but if you look at pages 5 and 6 and the performance numbers listed there, and on page 5, you have basically all the equity managers, right? Look at the 5 and 10-year numbers for the dark gray shaded segments.
Okay.
And then also look at the benchmarks for each of those segments. The Russell 1000, the Russell 1000 value, the S&P 500. Look at those 5 and 10-year returns. And then come down and look at now we haven't had the income segment for 5 or 10 years, but they do provide 5 and 10-year benchmark numbers. Look at the benchmarks for those managers compared to the benchmarks for the equity managers. They're half or less over the 5 and 10-year periods for everything except real estate. Real estate is
that a paid up benchmark too because of the structure?
well, it is, but it's an indicator of what you should expect your managers to do. I mean, it's a benchmark for a reason, because
They made that benchmark.
When they do your annual evaluation, you've reached it. Doing well, you need improvement in this area.
That 10-year, 5 years from now, it's probably gonna look a little crappier for equity though. But,
well,
or at least 5 for sure.
Depends on how long you think it's gonna
Well, you said the general pension is what, a 90-10 split? And how long has it been like that?
since the early 2000s.
And how does it perform? I mean, have you compared the two?
Yeah, but we look at it all the time. It's outperformed this portfolio by about 150 basis points annualized, which doesn't sound like a lot
Well, that's 1.5%.
every
But
year.
what you're talking about this one, yeah.
So you're talking about the difference between 9% and 10.
The magic of compound interest.
So the 10-year number is 10% on
What's-
this one.
What's the assumed
So
growth
100
rate
basis point.
of the general plan?
It's the same, 7 point. We just lowered it to 7.75.
Well, now that would be an interesting comparison, William. I mean, that's not that anyway, that'd be much more of an apples and apples comparison.
Since 1994, it's total funds 8.72%. 10 years, 10.4.
And keep in mind, you're looking at it
as of May.
as of May with a 20% down year-to-date equity market. So, you're skewing it, and you're skewing the equities quite a bit this year.
Right.
That's the May 31st number.
Well, risk aversion is Risk aversion it benefits to some extent, I think, the credibility of the plan. From among.
And to your point, you know, you don't have to get out of the, delegated investment program to change the asset allocation.
Yeah.
But to me, part of the delegated program, part of what Willis Towers Watson uses the delegated program sort of authority that they have is to focus on these income segment managers. But you know, it's the board's choice what you want the asset allocation to be. And I don't want to draw this discussion out. This was just something that, you know, Harvey had asked about, and some of the other board members weren't familiar with this arrangement that we have and what it meant and what it included. So that was the reason they created this presentation.
I would really like to wait a year to look at that, but
When you're off the board.
Yeah. You mean for somebody else to look at it?
no, I think I'll still be here.
I'm not recommending changing the asset allocation right now.
Just because it has been such a great decade, I think it's hard to look at, you know, but one bad year might skew it ridiculously too. I don't know.
Well, I'll also give you a lot of insight from this positive. Because all their, you look at their page 19, 20, their estimated returns, what their objectives, way out kilter. But maybe the true number is about 20%.
Well,
of their estimate.
Some of my fear is some of that fixed stuff, I think is gonna be tied to the housing market. And if that takes a major dip, maybe people won't, all those loans going to rebuild homes and stuff, they might not.
Well, I don't think they're,
Maybe even at 6%.
No, yeah.
you don't see the same low quality
Right.
mortgages now that you did back in 2007,
Yeah.
2008.
So
2 years ago, I would agree with you that they weren't giving everybody money, but this last year or so, I mean, it's been ridiculous.
A lot more cash buyers now than ever before.
Yeah.
You know, it was funny, in 05, one of our guys got hired, walked into Bank of America. He'd been here 3 months, making 35,000 on the book, something like that. In 20 minutes, he was approved for $450,000. That was in 05. And it's kind of swung that way again.
Yeah.
Like I had to refinance rolling some of my wife's student loans or whatever. It's a good interest rate. I knew they were going to go up. They didn't even bother to assess it. They're like, yeah, you had one a few years ago. And they're like, you can get up to triple what it's worth. And I was like, no, just that, just a little bit. Like I couldn't believe the number they threw out there, and without even sending somebody out to the house. So.
Well, and again, I'm not recommending any changes right now. I just wanted the board members to have this information so you could think about it.
It's an interesting, nevertheless, an interesting discussion. And it doesn't hurt for all of us to be novices. Once in a while. Stuff we think.
I'd like to do a little
is not
research
actually-
to see how we are as far as our standard,
I
because
mean,
I don't know.
to Eugene's point about housing sensitive impacts.
Yeah.
That is one Sharp's 100% of its strategy.
Right, I don't think they're gonna be
Throwing
making
money
money.
at flippers and hoping to get it back, you know, at a higher rate, higher interest rate, short duration, but
I don't think that's as secure of
but
a investment, but. I don't get paid the big
Whole
bucks either.
wide, wonderful world of investment opportunities out there that I don't want to know anything about.
converting homes, single
Yeah,
family to
just what
duplexes
I'm
in
a-
Gainesville, that's.
Well,
I've
there-
always been a very
you know,
risk averse kind of guy.
Although I review the managers, I don't have the time to actually do ongoing in-depth analysis on the managers. So
Right,
that's
yeah.
what we
And that's-
rely on Willis Towers Watson to do. And what you would hope is that if they see some issues with a manager like One Sharp, that they'll come to the board and, you know, they'll say, well, we think we've seen them perform as well as we're going to, and maybe we want to shift assets away. Now, the problem is,
It'll take
like it is with a lot of these, it takes time to get your money out of these managers, especially in a bad market, because they're illiquid.
Oh, that's,
Yeah, the underlying asset.
Illiquid.
Sometimes it hurts, and sometimes it's saving.
well, then you become.
The liquid ones
owner
you
of
can
an
call
investment
and make it happen in a few days.
Yeah.
Right?
Well, so like Principal, they're liquid until the market locks up, and then they put a gate on any withdrawals, and, you know,
That's what Brian said.
so. it can be an issue, but we'll just continue to look at it.
Not to go on it, but does the city get any feedback on your financial disclosure forms? I didn't get a response this year, but usually every year I get a response.
No, I mean, we don't get anything. That would go directly to you as the.
Okay, I'll send her an email when I get home.
Usually they mail me a copy.
No, I never got a response.
I just
I got an email back from him.
Did
I
you?
said lunch.
From the
From Kim.
supervisor of elections.
I forget the
I forget the lady's name that deals with those in particular, but she responded.
for Latchwood.
Yeah.
It was recent.
Yeah, I should have emailed mine. I stuck it in the mail.
Sure, I'll find out if I didn't.
All right.
Very possible.
So the best determined, we'll talk about next meeting we have. Bob is present.
It's the date of the next meeting.
That's what we needed. Did you have any input on the
Possibly July 27th.
annual report?
Just that it's
It's
been
been sent.
sent and, typically the process is the Division of Retirement will review it and they'll send us, a dozen or so questions about it and we'll get those returned as soon as possible and then it'll be approved. So, I would make the point that although we've got the annual report itself submitted, and we hope to have the VAL, and we'll talk about possibly scheduling a July meeting to approve the VAL. But we hope to have the VAL in a few weeks. And another component of the annual report submission is that the state requires the submission of post-audit financials. We probably will not have those until September. So there could be a delay in the receipt of the fiscal year 21 premium tax money, which we would normally receive in September of 2022. So it
So
might
it'll
be
be a
pushed
lag if they
into
don't get their- if
October
they don't-
or November or something like that.
Has that traditionally always been how the money came the following fall?
Yeah.
So the first money we got was 99.
I have to go back and,
Some places got it 97, but I don't think
so there was a base year.
we did in 97. We just didn't get an increase till 99.
Right. So, yeah.
Will you know the amount beforehand, even if it's not dispersed until later?
We will.
Yeah,
Normally
the
we'll get a
statements, yeah.
notification in July or August what our share
Yeah.
amounts will be.
All right, so
So we did want to see if the board wanted to meet in July. We don't currently have a July meeting scheduled.
I'm looking for one.
do we want to pick 2 days? That way we give Bob an option.
Yeah, or just even a week, if there's a week in there, I would suggest the 3rd or 4th week of July. If there are dates that that would work for you, for members. I think what we need to talk about is there's a disability that we want to review. There's the issue of the vested terminated.
Will that be ready by then?
It's,
Maybe.
the stuff is in.
Okay.
It was God, Keith Collins, I think the last one this board has.
No, we've had a few since I've been on. Couple of
Disability?
police officers,
Okay.
a firefighter.
But they were,
Yeah. The last week of July and first of August is not good for me.
Maybe the 3rd week of July.
Third week is okay.
So I'll present Bob with some dates and include everyone else on the email to see if those dates work for you as well. I would typically, try to schedule it for the same Wednesday at 9 a.m. Maybe the 3rd week of July.
That would be dedicated just to that issue. Is that true?
No, it would be
And the other issue.
vested terminated. There's some questions. How we did things in the past, the disability
And
and
the
maybe the vow.
We wouldn't schedule Willis Stars Watson
Right.
our manager. It would just be some
Okay.
internal discussion. So it would be,
Please don't.
their assumptions.
so we're
And if
looking.
will we get all that paperwork beforehand?
Yeah,
That's what
yeah, you-
I've asked. That was one of the questions I'd sent Bob a few weeks ago.
Because in the
I'm
past,
not
we've
knowing
got all
even
the documents to look through before we came in.
Oh, yeah, you'll have it beforehand.
Okay.
It's the extent to how much of it. Because the board hired
We have a
an
doc-
independent
we have a board doctor.
medical review officer who gets
Right.
all of the records, okay, Eugene? And then they formulate a short summary and,
We may disagree with it, but that's
Right.
neither here nor
yeah, I
there.
mean, yeah, so. But he doesn't say yes or no, he gives you the facts.
The medical review officer.
Mhm.
I thought that occurred after the initial evaluation in front of the board. So
No.
when they present with documentation saying that I'm
So when
totally
they
permanently.
present an application for disability,
Mhm,
they get an affidavit that lists all their
mhm.
providers, and it's a release to send that stuff to you, the board's
Mhm.
medical officer.
I think there's
So,
three
so that's
options.
part of the process of disability. We don't have to say, yes, they can apply and do that. You-
So when the board is given the recommendation from the medical doctor, that's not their personal doctor.
No, it is
Correct.
independent. Now, it is based largely on records received from their
Of
treating
course,
physicians.
Right.
I thought that was
Focusing
from their,
around restrictions, permanency.
I thought that was from the
quite
workman's
frankly,
comp doctor or their personal doctor. I always thought it was from the work comp or their personal. And then we decided yay, nay, or medical review, where then it goes in front of 3 other doctors, correct?
No, it doesn't. It goes directly from their providers to
Okay.
the review, kind of truncate the process so that it's already done.
But there's still an option to have another medical review.
Mhm.
Okay, all right.
Is that with a different doctor?
Yes, three doctors. I think. Never seen it.
Well, I mean, depending on the number of providers the individual has related to their condition or conditions that, you know. The plan definition is pretty easy. It's wholly and fully able to perform the essential functions of a police officer or firefighter. So it's not a social security definition, it's an occupation, so.
So like, yeah,
Can we, as the board, this is, well, you remember, this is the issue that can we as the board direct the chief of police or the fire chief that they have to retain a limited duty position indefinitely?
No.
I would suggest that's board overreach, but, you know,
I think everybody-
that's meant.
A lot of people
Yeah,
agree with
yeah.
that, yeah.
they either have it or don't have it.
Yeah, because it takes away from, it takes a person off of fire.
I mean,
He's in fire equipment.
that's the purpose of
And
a retirement.
Sergeant Hayes
benefit
knows that's
or
one less
worker
person
comp.
that can patrol.
Yeah, I mean, that's the purpose
So,
of a worker comp benefit or a retirement benefit. So you have a fully staffed group of people out there doing what what
in the
the
police
taxpayer
department.
expects them to do.
Depending on the staff, if administrative roles, it's dispatches, all kinds of things.
But then, yeah, if they want to be, well, I guess dispatcher, I mean, a DM.
So
How many
Different.
administrative police officer positions are we allocated?
I have no idea.
So I always
Question
agree.
is that-
Different police chiefs have had different attitudes towards that ATO position.
Yeah.
As you know. There were some that I can't have a position that can't be deployed in the manner that GPD needs to deploy that
Right.
asset.
And are they all in our pension plan or do they fall in the general plan?
Sworn
APO,
officer, they're all in the general plan, in the pension plan.
Because that would be the difference, because if you're injured, you can't be a firefighter, then you can't stay in the pension. So you have to find a job
Yeah,
outside.
where
the
did
pension.
If they
APO
lose
fall?
their certification, yeah.
Yeah,
Do they fall under?
Well,
our
if you get a
pension?
doctor's note that says you're totally and permanently disabled as a firefighter, I'm pretty sure you lose your minimum standards, but.
Yeah, I would agree that they are not a high-risk position anymore.
Anyway, all right.
Just like I would say an APO probably isn't a high-risk position anymore.
Is there any public comment?
is there any public here?
Seeing none and hearing none.
We're not exactly.
Not exactly the public.
Well,
And I should introduce Sue Wang. She's the new controller for the city. So Jennifer and Sue joined us just a couple weeks ago.
all right.
To you both.
Last Monday. Yeah.
A week
same
ago.
day.
Your absences were
Welcome.
truly noted and we're glad you're here.
Thank you.
We're gonna shoot for is there any other member comment? We're gonna shoot for the 3rd week of July, correct?
And I'll send emails to everyone and Outlook invites once we confirm with Bob what date works.
All right, motion to adjourn would be in order.
Motion to adjourn.
I'll second that.
All in favor?
Aye.